Hey, and welcome. In this episode, I'm going to show you how you can pay yourself $30,000 when you purchase your next apartment building with investors. So you deserve to be paid when you put the deal together. And in this episode, I'm going to talk about and show you how that's done. When I bought my first 12-unit apartment building, I put the entire deal together with a handful of investors. And I paid myself $15,000 at closing. This was a very small deal. It was like a $475,000 deal. So, a little bit larger deal. There's no question you can pay yourself more than that. Now, let's talk about how to do this, okay? Let me address first one situation, which is a lot of people, you, the investor, putting a deal together, don't feel they should be compensated. Okay, let me address that right now because the answer is yes, you should. Here's the thing. You're doing a lot of work. Number one is you are pounding the pavement looking for deals. You're scouring everything. You're actually going out, driving, looking at deals. You're crunching numbers. You're negotiating. And the truth is 99% of your time that's spent goes nowhere. The deal goes nowhere. You're spending all this time and you're never getting paid for any of that stuff. So 1 out of 100 all of a sudden you have under contract. You get on a contract, and while this is going on, you're investing in your education. You're out there doing deals. You are meeting people and raising money. Okay, you are, number two, bringing together individual investors that are investing $100,000 a piece. But without you, they would not have that investment. They would never have the opportunity. So you're actually going out there, you're identifying people that live around, and you're putting them together so that you can do something as a group. Okay, so you're putting the money together. Then number two, you're negotiating everything. You're doing the diligence. You're possibly putting your own money at risk during the due diligence. And let's say you finally close on it. Hooray. But now the real work begins. Now you're actually managing this building. Okay, so you did all the hard work. You closed on it. Now you're actually responsible for managing it. Even if you have a property manager, okay, you need to identify, interview, hire, and manage that property manager. And you have to provide reporting back to the investors. That's a lot of work. And don't you think you should be compensated for that? I mean, fairly, as in separately than whatever equity or money you may have in the deal? The answer is decidedly yes. So get over it, okay? You need to compensate yourself. So there's 3 ways to do it. One is upfront when you close the deal. It's called an acquisition fee. And you build it into the deal. It's disclosed to all the investors up front, verbally, as well as in the operating agreement. Everything is disclosed. And you pay yourself a fee anywhere between 1% and 3%. Okay, whatever makes sense. If the deal allows for it, pay yourself 3%. Look, the broker gets paid, 5 to 6%. So there's no reason why you should not be paying your acquisition fee. And that's really the nice thing about doing deals is the acquisition fees. The second way you can pay yourself is with an asset management fee. This is normally done for larger deals where you pay yourself 1 to 3% of any income that comes in. You then pay yourself as the asset manager, meaning that you are managing you have some active duties that you're doing. You're managing the property manager. You may have to replace that property manager. You're providing reporting to your investors. So that's kind of the asset management fee. And the third way you get paid as a syndicator is a disposition fee. Okay, and that is paid on the back end, either when you return the principal to the investors, and again, it's 1 to 3%, whatever the deal allows for, or when you sell it. Okay. And this is in addition to, if you put your own money in, there's 2 other ways you can make money. You put your own money in, you of course become an investor, and you're getting proceeds as an investor. You're also going to get equity as a syndicator, whatever, 10 to 20 to 30%, whatever the way you slice it, and you're going to get paid distributions out of that as well. Those are all the ways that you can get paid on a deal. Now, but here's the key. The investor earns have to drive the entire deal. Okay, meaning you can't pay yourself all this money and the investors don't make their return. You can only pay yourself as much as your investors, as a return to your investors allow. So for example, if you were looking for a 10 to 15% return, let's say it's 13%. Anything that then would decrease that return below that mark, you can't pay yourself. So you might have to either not pay yourself or pay yourself less. But here's the warning though. If you're not paying yourself anything to make the returns for your investors, it's a sign that it's not a good deal. Look, you got to be on the same page as your investors. If you don't make money, and your investors need to understand this, if you don't make money on a deal, there's no incentive for you to do a good job and get the returns for your investors, okay? If they start heckling you about all this money you're getting paid, you got to convince them that you're on the same page, okay? If they make money, I make money. All right, and there needs to be an incentive up front to do a good deal while you own it, and then when you dispose of it, you need to be compensated and get an incentive along all those things. The best tool, of course, for estimating all the stuff is the Syndicated Deal Analyzer, which you can get off my website for $129. Let's go to syndicateddealanalyzer.com, and it's this spreadsheet on steroids that, with very little information up front, very quickly gives you projections for the returns for all your investors, cash-on-cash return, overall return, IRR, as well as allows you to play with different acquisition fees during the thing and quickly see how that impacts the entire model. So it's very useful when you're doing the deal all the way from the time the marketing package comes in to actually doing diligence, closing, and even while you manage the property. So it's a priceless tool. It's cheap for $129. If you don't have that, then you need to have something differently. So bottom line is, make sure you pay yourself in these deals. Pay yourself up front at closing, and option for sure, no question there, and optionally while you own it and when you dispose of it, if the deal allows for it. And of course, make sure that you retain equity in the deal as well as a syndicator. Thanks very much for listening. Catch you on the next episode.